So this is one part of the answer. Second, sale value. If investment is taken at sale value. So right now the total sales are 120 lakhs into 35 days credit period, 35 by 360. $11,66,667 is the investment. In proposal case, 180 lakhs is the sales, 50 days credit, 180 into 50 by 360. So opportunity cost at the rate 20%. Net benefit. $2,40,000, $3,60,000. So 2,40,000 minus 2,33,333. 6,667. 3,60,000 minus 5 lakh. 1,40,000 loss. Still we are conveying the same message or same conclusion. Axle Limited should continue existing credit period of 35 days. Since net benefit is higher. If X Limited extends the credit period to 50 days, it would suffer loss of 1,46,667. You have to forego 6,667 profit, and you have to suffer a loss of 1,40,000. The total loss 1,46,667. Now you can take variable cost or you can take sale value approach. Both methods conveys that the present credit period of 35 days should be allowed to customers, and it is not advisable to extend the credit period to 50 days. This is how investment in debtors will be computed. At the same time, the valuation process will be completed. I repeat once again. So investment in debtors. This is quite simple. Variable cost, sale value, variable cost into debtors collection period by days. either 360, 365. In case of months, divided with 12. In case of weeks, divided with 52 weeks. Here, sale value into DCV by 360. This is common in both cases. The only difference is in first scenario, variable cost is taken, that is 85% of sales. This case, sales is taken. You can observe that investment in debtors is higher when you take sale value approach, lower when you take variable cost approach. You can see 11,66,667, 25 lakhs is the investment in both cases. 9,91,667, 21,25,000. You can also calculate this. So this is the investment in debtors based on sale value. 11,66,667. If you take 85%, you would get the same answer. 11,66,667 to 85%, that is 9,91,667. $25 lakhs is the investment in debtors based on sale value. If you take 85%, you would get the investment in debtors based on variable cost. So first, the alternative way is you can compute the debtors, investment in debtors sale value, and then take 85%. Then automatically you would get the investment in debtors based on variable cost. Logic is quite simple. Investment in debtors based on sale value consisting of variable cost plus profit. So when you take investment in debtors at variable cost, you must consider 85% of that. That's why 85% of investment in debtors based on sale value is equal to investment in debtors at variable cost. Since variable cost 85% of sales. So up to this, problem number 14 is completed. Problem number 15. X Limited X Corporation is considering relaxing its present credit policy and is in the process of evaluating two proposed policies. Currently, the firm has annual credit sales of 50 lakhs. Account receivable turnover ratio, debtors turnover ratio of 4 times a year. The current level of loss due to bad debts is 1,50,000. Here, bad debts are quantified and given. The firm is required to give a return of 25% on the investment in new accounts receivable. That means opportunity cost is 25%. The company's variable cost costs are 70% of the selling price. So variable cost equal to 70% of sales. Contribution is equal to 30% of sales. Given the following information. Which option is better? So present policy 1 and policy 2. At present sales are 50 lakhs. Debtors turnover ratio 4 times. Bad debt losses 1,50,000. It is quite simple. Debtors turnover ratio 4 times means in first problem, they clearly says that credit period is equal to 35 days in one's present. They want to increase it to 50 days. That is right way of expressing. So this is the indirect way of expressing. Debtors turnover ratio 4 times means they got payment from the customer 4 times in a year. You are getting 4 times payment means the firm is allowing 4 times credit in a year. They are saying in a year you have 360 days. Now tell me, in a 365 days year, you are getting 4 times credit means for each time you are getting 90 days credit. Simple. Therefore, the present credit period is 90 days. So, with the help of debtors turnover ratio, we should find credit period. Usually, it is given. If it is not given, debtors turnover ratio is given. It should be expressed like this. 3 times. 3 times means customer allowed to make payment 3 times in a year. So in 360 days 3 times means 120 days credit. 2.4 times. In 360 days 2.4 means 150 days. Therefore, present credit period is 90 days. If you adopt policy 1, option 1, you would like to increase the credit period to 150 days. If policy 2 is adopted, you would like to increase the credit period. Sorry. Okay. In policy 1, you would like to increase the credit period to 120 days. In policy 2, you would like to increase the credit period to 150 days from present level of 90 days. See, here tax is not given. That case, PBT is equal to PAT. So you can take 25% before tax or after tax because there is no difference. Both are equal. Then. Evaluation of credit policies. Days. Days. 150 days. $67 lakh 50,000 less variable cost at the rate of 70%. 35 lakhs. $42 lakhs. $47 lakh 25,000. less fixed cost not given. Collection and administration costs not given. Bad debts quantified and given. If they are expressed as a percentage, calculate on sale value. 1,50,000, 3 lakhs, 4,50,000. PBT is equal to PAT. Motex. $13,50,000. 15 lakhs. 15 lakhs 74,000. See, here total cost is not available. That's why I am taking investment in data based on variable cost. So 35 lakhs divided by 360 into 90. Sir, what is this 30 lakhs? Variable cost of 6. Or you can take 50 lakhs into 70%, then divided by 360 into 90. $8,75,000. Here 60 lakhs divided by 360 into 120. 20 lakhs. $28 lakh 1,500. $25. 7 lakh 3,125. 5 lakhs. 4,18,750. Net benefit 13,50,000. 11,31,250 is the present profit. 15 lakhs minus 5 lakhs. 10 lakhs. 15 lakhs 75,000. 7 lakh 3,125. 8 lakh 71,870. Now compare these three, whichever is higher. This is higher. Therefore, conclusion. XYZ Corporation gets higher benefit at existing credit policy. It is better to continue 90 days. Yeah. 11,31,000. That's 67,50,000. Absolutely correct. Okay. These calculations are not correct. So variable cost 42 lakhs, 42 lakh, 47 lakh, 25,000. 360 into 120. $14 lakhs. Into 24 3 lakh 50. Minus 15 lakhs. 11 lakh 50,000. Okay. $47 lakh 25,000. 47 lakh 25,000. 47 lakh 25,000 divided by 360 into 150. 19,68,750 into 25%. 4,92,188 minus 15,75,000. So 10,82,813. So whichever is higher? $11,50,000. Option 1. It is better to extend the credit period to 120 days. 120 days from 90 days. This is the conclusion. Problem number 16. Mosaic Limited has current sales of 15 lakhs per year. Cost of sales is 75% and bad debts are 1% of sales. Present sales 15 lakhs, cost of sales 75%. So cost of sales, we can also call it as total cost. Bad debts is equal to 1%. Cost of sales comprises of variable cost 80%, fixed cost 20%. Okay. While the company's required rate of return is 12%. Required rate of return, also known as opportunity cost, 12%. The company currently allows 30 days credit to customers, but it is considering increasing this to 60 days in order to increase the sales. Credit period 30 days. Proposed 60 days. It has been estimated that this change in the credit policy will increase sales by 15%. Bad debts will increase from 1% to 4%. It is not expected that the policy change will increase the fixed cost and creditors and stock will be unchanged should the company introduce the proposed policy. So they are saying that there is no change in inventory and the credit allowed by the creditors. So that means the only change is investment in debtors. It is not expected that the policy change will not increase, will result in, not expected that the change will result in an increase in fixed cost. That means the present fixed cost will be continued. There would be no change in fixed cost on account of increase in sales. In simple words, the present fixed cost is equal to fixed cost under proposed policy. So this is the preliminary data. Now, so we have to decide. Right now they are allowing 30 days credit. Is it better to allow 60 days credit or not? present proposed. Says 15 lakhs plus 15%. 15 lakhs into 115%. 17 lakh 25,000. Less variable cost 80% into 75% into 80%. %60 of sales. Nine lakhs. Fixed cost 75% into 20%. 15%. $2,25,000. So they are saying that it is not expected to change. And same fixed cost should be taken. It is the key point here. Few people are, so 15% of sales. Therefore, 17,25,000 into 15%. 2,58,750. So instead of taking 2,25,000, 2,58,750 recorded there. You have to remember that only variable cost varies with production. Fixed cost always remains constant. Therefore, the fixed cost at present level will continue. It is not expected to change. That's why fixed cost at present level has been estimated. The same is considered when the sales increases by 15%. Because it is a capacity cost, up to some capacity it is not expected to change. For example, at 100% capacity, I can produce 1 lakh units. Right now, I am operating at 60% capacity, producing 60,000 units. Due to export order, I have to operate at 80%. In that case, I have to produce 80,000 units, 20,000 units extra. See, the fixed cost which was lying at 60,000 units is the fixed cost at 80,000 units, because I am not exceeding the full capacity, that is 1 lakh units. Up to 1 lakh units, you can produce 1 unit, whatever fixed cost was there. For 1 lakh units, the same fixed cost will continue, because fixed cost related to capacity, not related to activity or production. So you are paying rent for the entire building. Therefore, you may produce 1 units or 1 lakh units, rent would be the same, like that. Then bad debts 1%, 4%. $15 lakhs into 1%. 15,000. 17,25,000 into 4%. 69,000. No collection expenses. This is profit before tax. Since we don't have tax information, this is PAT. So 15 lakhs minus 11,25,000 minus 15,000. 3,60,000. 17,25,000 minus 10,35,000 minus 2,25,000. 3,96,000. B. Opportunity cost. First, find out investment in debtors. See, since we don't have any specific method to find, three methods are yes, we can take three methods: sale value, total cost, and variable cost. I am considering based on total cost. So total cost means variable cost plus fixed cost. 9 lakhs plus 11,25,000. So 11,25,000 divided by how many days in a year? 360 into what is the present credit period? 30. Variable cost plus fixed cost. 11,25,000 divided by 360 into 30. 93,750. 10,35,000 plus 2,25,000. 12,60,000. Into 60. You let 10,000. Opportunity cost at the rate of how much? 12%. 25,200. 93,750 into 12%. 11,250. Net benefit period of 48,000. 48,750. 3,96,000 minus 25,200. 3,70,800. So whichever is higher? As net benefit is higher, it is better to extend the credit period to 60 days from 30 days. So the answer 22,050 is the difference between these two. 3,70,800 minus 3,48,750, 22,050. They are saying that if you allow 60 days credit, you would get additional profit of 22,050. The conclusion is the same. To get 22,050, what you have to do? You have to extend the credit period from 30 days to 60 days. We have to convey whether to extend the credit period or not. How much profit you are getting, that is the difference that need not be disclosed. Hence, as net benefit is higher, it is better to extend the credit period to 60 days from 30 days. That's all. Next, problem number 70. A trader who current sales are in the region of 6 lakhs per annum and an average collection period of 30 days wants to pursue a more liberal credit policy to improve sales. Right now, a trader allows 30 days credit to its customers having a revenue of 6 lakhs. He wants to increase the credit period to increase to boost the sales from that region. A study made by the management consultant reveals the following. So A, B, C, D. There are 4 policies. Increase in credit period 10 days. That means the total 40. Increase in credit period 20. So 30 plus 20 50. 30 plus 30 60. In D 30 plus 45 75. So they also given the sales, increase in sales and bad debts percentage. So the difference is that up to now we have studied the present policy versus one policy, the present policy versus two policies. In problem number 15 you have studied credit policy along with option 1 and option 2. Now apart from credit policy, you are studying 4 policies A, B, C, D. Now you have to decide, is it better to continue the existing credit policy or go for any of these 4 policies. That means among them which is the best plan. The selling price is 3, total cost 2.25, variable cost 2 and the bad debt losses 1%. Required return on investment 20%. Which policy should be adopted? 1 year is equal to 360 days. Evaluation of credit policies. Particulars. A, B, C, D. Sales. Tell me 6 lakhs. 30,000 extra. 6 lakh 30,000. 48,000. 6 lakh 48,000. 6 lakh 75,000. 6 lakh 90,000. Less variable cost. So out of 3 rupees, Out of selling price is 3, variable cost is 2. You know that variable cost as a percentage of sales, 2/3, 66.666%. Four lakhs, 6,30,000 into 2/3, 4,20,000, 6,48,000 into 2/3, 4,32,000, 4,50,000, 4,60,000, contribution. I don't want to write less fixed cost. Sir, no information, nil. No. See, we have total cost information and variable cost information. The difference between two is the fixed cost. I will give a small note here. Note 1, fixed cost. Note 1, fixed cost. Sales volume 6 lakhs total sales, selling price per unit 3, 6 lakhs divided by 3. We are selling trader is selling 2 lakh units. Total cost 2.25. It consisting of variable plus fixed. Variable cost 2 rupees means fixed cost per unit 0.25. Therefore, total fixed cost 2 lakhs into 0.25. 50,000. This is how fixed cost has to be calculated when you have total cost information and variable cost information. Less collection cost, less bad debts, present 1%. Explains. 9,450. 6,48,000 into 2%. 12,960. 6,75,000 into 2%. 20,250. 6,90,000 into 4%. 27,600. Therefore, PBT is equal to PAT here, no tax, plus 50,000, 4,60,000 minus 1,52,400. 1,50,000. 1,44,000. 6,30,000. 550. 1,53,000. 40. 6,75,000. 1,54,750. Based on total cost. 4,50,000. So 4,50,000 is the total cost. See, I am adding this variable plus fixed. I told you, if I don't have any information, investment data always calculated at total cost. $360 into 30. 4,50,000 divided by 360 into 30. 37,500. 4,20,000 plus fixed cost 50,000. 470 divided by 360 into 40. Credit period 30, 40, 50, 60, 75. $4,20,000. 52,222. 4,32,000 plus 50,000 divided by 360 into 50. 66,944. I am not disclosing all the calculations. How the calculation is made was disclosed here. The same logic will be applicable for the remaining calculation. Total cost means variable cost plus fixed cost. So 5 lakhs divided by 360 into 60. 83,333. 5,10,000 divided by 360 into 75. 1,06,250. Opportunity cost at the rate 20%. $7,500. $21,250. $52. Correct. Correct. That's 39,651. 1,54,750 minus 1,38,083. 1,52,400 minus 1,31,150. So out of this, whichever is higher? So conclusion, since as net benefit is higher, so credit policy A, trader has to increase his credit period from 30 days to 40 days. So I am saying in all the cases the standard assumption is that it is not necessary to write, because they will clearly tell you which method of valuation should be adopted. Investment in debtors has taken at total cost basis.